Hey everyone, welcome back. Today we're going to be diving into the world of passive income.
Ooh, passive income. That's a hot topic these days.
It is, especially with, all the uncertainty about retirement benefits these days and inflation eating away at everyone's savings.
Absolutely. People are looking for ways to make their money work harder for them. And passive income is definitely...
A great way to do that.
Yeah.
Exactly. So we're going to take a look at 3 specific dividend-paying stocks that were recently recommended by the Motley Fool.
The Motley Fool. Yeah, they've got a pretty solid track record when it comes to investing advice.
Yeah, they do. So we're not just picking these stocks randomly. They've been carefully chosen and analyzed by, a reputable source.
Right. So we can be pretty confident that these are at least worth considering.
Exactly. Now, these 3 stocks represent different approaches to passive income.
Okay. I like that.
So we've got Realty Income. They're actually known as the monthly dividend company.
Oh, wow. Monthly dividends. That sounds pretty enticing.
I know, right? Then we've got Costco Wholesale, which you might not immediately think of.
Yeah, Costco for dividends. Huh. Interesting.
But they've actually got some pretty impressive dividend growth.
Oh, okay. I'm intrigued. And the third one?
The third one is a bit more sophisticated. It's the JPMorgan Equity Premium Income ETF. It's JTI for short.
Ah, ETFs. Okay, so we're covering a range of options here, from individual stocks to an ETF.
Yeah, exactly. We wanted to give a good overview of different ways to approach passive income investing.
I like it. So let's start with this monthly dividend company, Realty Income. How do they even manage to pay dividends every single month?
Right, that was my first question too. What's the secret sauce?
Well, the key is that they're structured as a real estate investment trust, or a REIT for short.
Oh, okay, a REIT. So that means they own and manage properties that generate income.
Right,
Wow.
exactly. And Realty Income has been doing this for a long time. They've actually increased their dividend payouts annually for almost 3 decades straight.
Well, 3 decades. That's amazing. So it's not just that they pay monthly, it's that those payments are very likely to keep getting bigger over time.
You got it. That's a huge plus for anyone looking for a reliable passive income stream.
Okay, but where does all this income come from? I mean, what kind of properties are we talking about here?
Well, it's not just one type of property. Realty Income owns over 15,450 properties across 8 different countries.
Wow, 8 countries. That's impressive.
It is. And these properties span a variety of sectors. You've got retail, industrial, even gaming locations.
Gaming locations. Okay, that's interesting.
Yeah, it's all about diversification. If one type of property isn't doing well, they've got others to balance it out.
Makes sense. It's like they're spreading their bets across the entire real estate world.
Exactly,
Yeah.
which helps protect them from downturns in any one area.
So how do we know that they're actually making money from all these properties?
Their financial reports look pretty solid. In the third quarter of 2024 alone, they generated $915.6 million in adjusted funds from operations, or AFFO.
AFFO. I'm not familiar with that term. What does that mean?
Oh, yeah. AFFO is a key metric for REITs. Basically, it's a way to measure their cash flow from operations, taking into account things like property maintenance and other recurring expenses.
Oh, okay. So it gives you a clearer picture of how much money they have available to actually pay out as dividends.
Exactly.
So in Realty Income's case, that $915.6 million AFO number means they're generating a lot of cash that can go straight back to investors.
Exactly. And they're actually projecting that their AFFO per share will increase by 4.8% for the full year of 2024.
So they're not only stable, they're also continuing to grow.
Right, which is always a good sign for future dividend increases.
Yeah, and they're already offering a 6% dividend yield, which is pretty darn good.
Oh, yeah, especially in this market.
Okay, so Realty Income. They're offering high current income with a strong track record of reliability and the potential for growth.
Yep, that's Realty Income in a nutshell. Now let's move on to a company that you probably interact with all the time but might not think of in the context of passive income.
Okay, I'm curious. Let's hear it.
We're talking about Costco Wholesale.
Costco. Really? I mean, I love Costco, but for passive income.
Yeah, I know. It might seem counterintuitive, but Costco is actually a dividend growth champion.
Okay, I'm listening.
Now, their current yield is only 0.47%, so it might not seem impressive at first glance.
Yeah, that's pretty low.
But the real story with Costco is their potential for long-term growth.
So we're not talking about big payouts right away, but more about the potential for those payouts to increase significantly over time.
Exactly. Over the past 5 years, Costco has increased its dividend by an average of 12.3% annually.
Well, hold on. 12.3% every year for the past 5 years.
That's right. It puts them among the top dividend growers in the entire market.
Okay, that's impressive. I'll give you that.
Yep.
But what makes them so good at consistently increasing their dividend like that?
Well, their business model is a big part of it. Their membership-based structure provides them with a very consistent and predictable revenue stream.
Right, because everyone needs to buy groceries and household items.
And Costco makes it so easy and affordable to do that in bulk. They boast renewal rates above 92%, which means most members stick around year after year.
Yeah, no, I'm definitely a loyal Costco member.
And that's the key. Costco focuses on providing value to its members, which translates into loyalty and consistent revenue. They're also masters of operational efficiency.
Right. They keep their costs low and their profit margins high.
Exactly, which allows them to reinvest in the business and reward shareholders with those impressive dividend hikes.
So for someone who's patient and looking to build wealth over the long term, Costco's ability to deliver consistent double-digit dividend growth, that's a major draw.
Absolutely. Now, our final pick for today is a little more complex, but it offers the potential for even higher yields.
Ooh, okay, I'm intrigued.
It's the JPMorgan Equity Premium Income ETF, or JEPI for short.
JPI. Got it. So we're talking about an ETF here.
Right. JPI takes a more sophisticated approach by combining traditional stock holdings with a covered call options strategy.
Okay, I know options can sound intimidating to some people. So can you break that down for us? What does that actually mean?
Sure. Basically, they own shares in major companies and generate additional income by selling call options on those shares.
Okay, so they're making extra income on top of any dividends they receive from the stocks they own.
You got it. They're essentially getting paid for the potential of selling their shares at a certain price in the future.
Okay, that sounds pretty clever.
Right. It can be a powerful strategy for generating higher yields.
But I imagine there are risks involved as well.
Of course. There's no such thing as a risk-free investment. We'll definitely unpack those risks in more detail in part 2 of this deep dive.
Okay, good to know. But for now, what are some of the key things our listeners should know about JPI?
Well, JPI offers a high yield potential of 6.98%, significantly higher than many traditional dividend stocks or ETFs. And they distribute those earnings monthly.
Monthly distributions. Nice. So it provides a regular and predictable income stream.
Exactly. Plus, the fund holds a diverse portfolio of blue-chip companies across multiple sectors.
So it's not like they're betting everything on one or two companies.
Nope. They're spreading the risk around,
Yeah.
which helps to mitigate potential losses.
So JTI, it's for investors who want substantial passive income, but are also concerned about balancing that with investment quality and growth potential.
That's a great way to put it.
Okay, so we've got Realty Income, the steady and reliable one, Costco, the long-term growth champion, and JKPI, the high-yield innovator.
It's fascinating to see how different companies can offer such diverse approaches to generating passive income.
I know it is, and that's why it's so important to understand your own investment goals and risk tolerance.
Absolutely. What works for one person might not be the best fit for another.
Exactly. So we'll be back in part 2 to dig a little deeper into each of these companies and explore some of the nuances of their strategies.
Yep, there's always more to learn.
All right, so we're back. We spent part 1 getting to know Realty Income, Costco, and JEPI. As we've been talking about them, it just kind of makes me think how important it is to, really know your own investment style, right? It's not just about chasing the highest yield or the fastest growth or anything.
That's a really good point, because what might be a perfect fit for one investor could be a total disaster for another.
Right, exactly.
Yeah.
So like a younger investor who's just starting out and has a lot more time to kind of ride out the ups and downs of the market,
Yeah.
they might be totally comfortable with a growth-oriented stock like Costco, even if that starting yield is lower.
Yeah, because they have time on their side. They can let those dividends compound over years or even decades.
Exactly. But someone who's closer to retirement, maybe they're looking for that more immediate income stream from a stock like Realty Income with those nice, reliable monthly payouts.
Right. It all comes down to your individual financial goals and your, risk tolerance. I mean, if you're someone who really values stability, that steady performance of Realty Income's real estate portfolio, that might be very appealing.
Yeah, like peace of mind knowing that those dividend checks are going to keep coming in every month.
Exactly. But on the other hand, if you're someone with a higher risk tolerance who's really looking for those potentially bigger returns, then JHEPI's option strategy might be more your speed.
Right, even though it does come with, a bit more risk.
Exactly. And that's where doing your research really pays off. Taking the time to understand those underlying businesses, the management teams, the potential risks and rewards associated with each investment.
Right, so you can make choices that you feel good about.
Exactly. And don't forget about diversification. We've been focusing on these 3 dividend stocks as examples, but a well-rounded passive income portfolio could include a mix of different assets, like bonds, REITs, maybe even some alternative investments.
Right, it's like building a financial safety net, with multiple layers of protection and income generation.
Exactly. You don't want to put all your eggs in one basket?
No, definitely not. So diversification is key.
Absolutely. And another thing to remember is that building passive income, it takes time. It's not some get-rich-quick scheme.
Definitely not. It's a long-term strategy. It requires patience, discipline, and a commitment to consistent investing.
Yeah. It's like planting a seed and nurturing it over time.
You got to give it the right conditions to grow.
Exactly. You set those financial goals, you develop a plan to reach them, and then you stick to it. Yeah. Even when the market throws some curveballs your way.
Because those consistent efforts, even if they seem small at first, they can really add up to a significant financial security and freedom down the road.
Absolutely. So keep learning, keep exploring, and keep investing in your financial future.
Okay, so we're back for the final part of our passive income deep dive.
It's been a great discussion so far.
It has. And as we've been talking about Realty Income and Costco and GPI, it really just highlights how important diversification is, right? It's not enough to just pick 1 or 2 stocks and call it a day.
Definitely not. You want to spread your risk around and build a portfolio that can weather any storm.
Exactly. So we've talked about these 3 specific companies, but what are some other asset classes that people could consider for their passive income portfolios?
Well, bonds are always a classic choice. They tend to be less volatile than stocks, and they can provide a nice, steady stream of income.
Right, and they can help to balance out the risk of those higher growth stocks.
Exactly. Now, another option is to invest in more REITs. Beyond just Realty Income, there are all sorts of REITs out there focusing on different types of properties.
Right, like healthcare REITs or industrial REITs or even data center REITs.
Right, exactly. So you can really diversify within the REIT sector itself.
Okay, that's interesting. Now, what about alternative investments? Are those worth considering for passive income?
Alternative investments can be a good option for some investors, but they do tend to be more complex and they often come with higher fees.
Right. So it's important to do your research and understand what you're getting into.
Definitely. But if you're comfortable with a little bit more risk and you're looking for ways to potentially boost your returns, alternatives could be worth exploring.
Okay, so we've got bonds, REITs, alternative investments. What else?
Well, don't forget about good old-fashioned savings accounts and CDs. They might not offer the highest returns, but they are FDIC insured.
Right, so they're very low risk.
Exactly. So they can be a good place to park some of your cash reserves, especially if you're not quite ready to invest in the stock market.
Okay, so the bottom line is that there are tons of different options out there for building a passive income portfolio. And the best approach is going to vary depending on your individual circumstances.
Absolutely. Your age, your financial goals, your risk tolerance, all of these factors come into play.
Right. It's not one size fits all.
Definitely not. So take your time, do your research, and don't be afraid to ask for help if you need it.
Good advice. And, one thing that I think is really important to remember is that building passive income, it's a journey. It's not a destination.
That's a great way to put it.
It's about making consistent efforts over time and gradually building up those streams of income.
Exactly. It's not going to happen overnight.
Yeah.
But if you're patient and persistent, you can achieve amazing results.
Yeah. It's like anything else in life. The more you put into it, the more you can get out of it.
Absolutely. So stay focused, stay motivated, and keep building that passive income machine.
Couldn't have said it better myself. Well, that brings us to the end of our deep dive into passive income.
I hope our listeners found it helpful.
I think so, too. We covered a lot of ground today, from specific stocks to broader investment strategies.
And we talked about the importance of diversification, risk management, and finding investments that align with your personal goals.
Exactly. So if you're listening and you're interested in learning more about passive income, please don't hesitate to reach out to us. We're always happy to chat.
Absolutely. And in the meantime, keep learning, keep exploring, and keep investing in your financial future.
That's right. Thanks for joining us on this deep dive, and we'll see you next time.